Good afternoon, everyone. Hello, my name is Edward Robinson. I'm a senior writer with Bloomberg News, and we are here for the late afternoon panel. I just want to thank you all for hanging in there, because we're going to have some fun talking about financing fintech growth in Europe. This is an absolutely critical piece of the whole fintech story, and I'm just so honored to have a fabulous panel of venture capitalists and investment bankers here who are going to share with us what the growth capital picture looks like in Europe. And I just would like to start, if I may, with a perception. And the perception is that when it comes to later stage startups in the European markets, there's the growth capital, the late stage capital is not as prevalent. It's harder to find. It's not as developed an ecosystem. I think the perception follows on too that institutional investors in Europe, from pension funds to insurance companies, either don't have the proclivity nor the ability, perhaps, to really put a lot of capital at risk in a venture capital play or a private equity play, the same way that we see in the United States, where there's just a lot more institutional capital flowing into that. And that has ramifications on fintech, especially as fintech evolves and matures and we start reaching a point where a lot of companies are getting to that stage. They've got revenue, they've got profits, and they really need that kind of growth capital. Now, that's the perception. Let's find out what the reality is. John, perhaps you'd like to kick us off. You're at TCV. This is your specialty.
Sure. So just very quickly, my name is John Rosenberg. I'm a general partner with TCV, and we are one of those firms that provide growth capital to later stage technology businesses. Ed and I were talking about this a bit earlier, and I actually would take issue with that comment, just given the level of competition that we might have for really interesting growth stage financial technology companies. Europe seems to have very significant centers in London, in Stockholm, in Berlin, and likewise, where we're seeing great businesses being built and grown, certainly here in Paris. And at least as far as the really attractive ones are concerned, and there are many of them, we see quite a bit of competition for investment. So I would say maybe the opposite, that there actually is quite a bit of capital, and more coming every day in the form of larger private equity firms who might be moving into the growth equity market, sovereign wealth funds and big pension funds. So it seems to be a really growing ecosystem, and a lot of that is being driven by the number of opportunities which are also growing. Is
there a particular bellwether deal that you would highlight, say in like the last 12 months, that really was kind of a jolt or really was encouraging? Or
not necessarily. There's been several of them. We have a portfolio company that presented earlier here called World Remit, which is a terrific business in the money transfer area. And Ishmael has spoken on a couple of panels today. But there's been loads of deals that have occurred, and we think that opportunity is only growing.
I see. Good. Arnaud, tell us about your organization. It's a very interesting bank. You have state backing, but you're deeply involved in supporting startups. And perhaps after you describe what it is that your organization does, can you just kind of put it in the context of the French startup scene now, especially in the Macron era?
Yeah, sure. So Bpifrance, we are a very French organization, as you can guess from the name. Very specific, probably the closest thing to us, if you look at the US, is Silicon Valley Bank. So somehow we are a state-owned Silicon Valley Bank. We have 75 billion euros of assets, 2,500 people, 50 agencies across France, and we are 100% dedicated to financing growth companies in France. So we lend like 15 billion euros per year to French companies, and we invest in equity around 2 billion euros per year. Among that, we have a 1 billion euro large venture fund, which is dedicated to growth high-tech companies. And the perception from ourselves is exactly the same as TCV. There is capital, for sure. There is capital in France. We have great VC funds, which are now the leaders in Europe, I guess. I don't guess, I'm sure. Many of them. So there is a lot of equity from private VC funds, including growth stage. You look at Kingsight, you look at Biotech, you have a lot of them waiting to invest a lot of money. You have 5 billion euros of dry powder in French VC funds.
And how would you define growth stage from your perspective?
Growth stage to me goes from late venture, so still EBITDA negative, but let's say more than 50 million euros of round of capital, up to whatever. Somehow, that's the interesting point. What is whatever? But it can, from what we see in France, most of the times it's 100 to 200 million euros. It's seldom more than that. Very seldom more than that.
Okay. Sean, would you agree with John's sentiment that the growth capital is alive and well and flourishing in Europe?
So. My name is Sean Park. I'm a mostly early stage, sort of up to Series A, Series B, although we follow on in companies. And when you are an early stage investor, it's actually a super important question, right? Because you have to understand the capital trajectory of the companies. You got to make sure that the winners can get financed to profitability or exit or whatever it might be. And I think it's a bit more nuanced than that. They're absolutely and this is all about jargon or semantics, growth private stage equity. Europe's super competitive. There's enough capital for everyone. It's slightly different market dynamics than the US, but I don't think capital availability is an issue. There's maybe two places where there maybe is a little bit of a gap, certainly versus the US or even Asia, is sort of late stage venture, so EBITDA negative. Oftentimes that'll show up at Series B or C, maybe D, depending on how the company's been financed. But that place where they need $20 or $30 million, but they're not quite, they're certainly not profitable, and they might be burning a lot of cash. And there's just, I think, the types of investors or the mentalities of the growth stage investors is maybe a little bit more less broad. So there's fewer, there's non-investors that are interested in that space. And then the other place, and I'm not so sure this is a bad thing for society, but it could be a bad thing for particular companies, is the company that needs a giant growth venture round, like where the winning chess move is to raise $200 million and own the market, far before it's a private equity size type company. That I don't think exists in Europe.
Does that exist in the US?
A little bit. There's a few of these mega, people like Sequoia and Andreessen Horowitz, NEA. They can write those checks. Now they're not common, right? But they have the ability to write those checks. In Europe, I don't think anyone does. I was super happy to see because they're amazing people, but I was super happy to see Atomico's last fund, which is $800 million. It's not quite in that league, but I think part of their thinking, is that that'll give them optionality, and they won't have a lot of competition. So when they're very special. They don't come along often, but when those companies come along, people like Atomico, Index has some bigger funds, some growth funds, but it's a buyer's market if you're in that space in Europe. Okay. Whereas in the States, there's a bit more competition, and then of course you've got folks like SoftBank, and then the big Chinese like some of the sizes of the venture rounds that happen out of China are, for a little guy who operates in the US and Europe, frightening.
Well, David, you manage a San Francisco-based venture capital firm. Give us your perspective coming to Europe, looking at the fintech scene right now, and as it's maturing, what are the growth capital opportunities you see?
Sure. David Blumberg, based in San Francisco and New York and Tel Aviv, and we've invested in US, Israel, Germany, Canada, UK. So we're relatively international for an early stage fund. And my diagnosis is not perhaps as optimistic looking backwards. I am optimistic looking forwards if Europe takes more reforms, and I think the new government here is trying against a lot of odds. There are a lot of vested interests they're trying to fight, but need work reform, tax reform, regulatory reform, all that still needs to happen. But I just happen to have the numbers here because we're sort of talking vaguely, but let me just give you the specific numbers. They're right here. Basically in 2015, 16 and 17. In 2015, the real number has been in Asia for these large growth rounds. I mean, there were 17 over $100 million rounds, 9 in the US, only 3 in Europe. In 16, Europe had a goose egg, 0, and there were 8 in each of Asia and the US and North America. And in 17, there were 20 in China or Asia, 11 in the US, North America, and 4 in Europe. So the numbers don't show a vibrant market for the later stage. I think what I see much more importantly is where is the market? And that's where the companies that I finance, I do the earliest stage, seed and A. When they come to Series B and C, they're saying, we want to be where the market is. And so they are often coming to Silicon Valley because that's where the partnerships are.
And those stats, David, is that, because this
Outside
is where
this
definitional
is
comes in, is that
from-
late stage venture? Because
These are mega
again,
deals, yes.
this is where
And this is
early stage private equity, where do those overlap and what are the definitions?
This is fintech global mega deals over 100 million.
Okay.
And it's from CB Insights.
Yeah, but they wouldn't count, I imagine they wouldn't count a lot of the private, like the traditional private growth equity deals, like, in the payment space and things like that.
Well, fintech
Maybe.
would, I would think, but yeah.
Yeah, but that like
fintech.
question mark. This is,
Fair enough.
I think it's an interesting dynamic. And
Sure. I mean, you asked about landmark deals. I mean, just in the payments area in the last year, we've seen Nets taken private. We've seen WorldPay has been bought for a huge amount of money. Bambora has been bought for well over €1 billion.
But those are buyouts, not growth capital.
Sure,
right? Yeah.
sure. But a lot of those are growth businesses or being looked at as.
yeah, but WorldPay
really
was
significant growth
Advent and
opportunities.
Bain. That was a giant growth deal that was done, then IPO and then sold. But I don't want to get. But I think that's the thing in Europe is that if there is capital, it's coming from the private equity side, right? So they may be stretching down in size or down in terms of.
And yesterday I met with one of the largest private equity groups in France, and he said to me the stage that is missing is what you talked about, the part that's late venture.
Late venture.
Yeah. After
So is
the
that Series
A,
C?
B, it's B and C. That's
and C.
what needs to be more.
I see a lot of
It's-
Series
it's-
B
it's-
rounds in
and
London, though.
It's also the stage before the private equity model. Sorry,
Okay.
the spreadsheets can take over. It's when you can't spreadsheet a company.
They're still
Yeah.
figuring out the product market fit.
Yeah, and the
they're
EBITDA
still
is
in-
negative, and
Right.
Well, I mean, the mother of all late stage rounds is the IPO. And Stefan, I mean, you run Euronext. Tell us about, I mean, you've had a lot of deals yourself. The Ireland exchange that's been acquired. Give us kind of state of play at your platform right now and what you're seeing in terms of fintechs possibly coming to your market and listing.
Yeah, first of all, apologies for being late, but
Of course.
I had a fire to extinguish. So, no, thank you for inviting me. I mean, I just want to, I mean, I'll give you 5 minutes of advertising after if you want to, but more seriously, what really matters is why do we have so few fintech IPOs?
Right.
And that's the real question compared to the rest of the digital world and so on. I think what we are facing here is probably maybe the European markets are backwards and we are just a bunch of Amish around here and we haven't understood the way of doing business, which is option one. Option two is that, and that has been heavily commented in other forums, but I think there is some element of truth in it. It's just fintech are just to a large extent R&D outsourcing or innovation outsourcing, implicit capitalizations of innovation by large financial institutions. So the usual debate that any technology company has at some point of time. Number one, do I sell, take the money, sell with a premium, take the money and run and cap my gain? Or do I get a great second run or third run of a big private equity and go some refill until I go to the IPO where then I sell with a discount but capture a good chunk of the upside. This usual debate in the fintech, which is common to technology since at least the early 2000s, is quite peculiar in the fintech world because it just has a good, solid, compact software company in the old good days were able, when they had proof of concept, a few references, some basic presence in the States, to be approached by the Adobe, Oracle, Microsoft of this world. The fintech have become the sort of reservoir of business development guys in large financial institutions, brick and mortars banks or insurance companies, which are heavily populated. Please don't tweet it by people who are so scared to death about fintech that have found an interesting business model, which is I buy a fintech company, hence I work. So that's a very important point.
So you think that there's an issue with the segment itself? There's something inherent in the segment itself that doesn't lend itself to an IPO because it's not a big consumer play. It's more kind of purpose-built company for large financial institutions.
Exactly. It has to oversimplify things. Just like many biotech companies end up being owned by large pharma group because there is one thing which is developing something and marketing it. To a large extent, fintech is the outsource is to the financial world where biotech are. Obviously, things are very different. The amount of capex in the biotech world has nothing to do with the amount of capex in fintech. Therefore, the cycle for getting to the point where they can sell is different. But clearly, the very nature of what fintech do, which is digitalizing the relationships or transforming through digitalizations the models of the finance world is a natural plug in the guys who already have clients, regulation framework, and risk management structures. So
okay, well, let's ask our VCs. What do you think? What do you make of that analysis, that there's something inherent about the segment that precludes perhaps late-stage, growth-stage capital investment and IPOs?
Well, I think some of it has to do with the nature of the business model. So if it's a capital-intensive business model, those may be more prone to be purchased by a strategic. Those companies may be bought by a strategic and layered in to lower their cost of capital, and that is a way for those companies to exit. But in areas where it's capital efficient, certainly we saw 10 and 15 years ago in the electronic trading area for institutional customers, whether it was in FX or fixed income or foreign exchange or what have you, there were a whole host of IPOs along those lines. The same thing holds true for payment services businesses that can be very capital efficient. You saw a lot of those companies going public. And then it also depends, I think, on your definition of fintech.
Yeah.
Because certainly there are a lot of companies that are selling software and data services into the financial markets,
right.
where we've seen a really significant number of IPOs, whether it's in the core banking systems or, like I said, in the payment processors all over Europe and the US.
I keep thinking of the WorldPay deal too. I mean, that's
Exactly.
Yeah.
Exactly.
One distinction maybe to be made are companies that are doing lending, which is typically extremely nationally limited and regulated, and then technology layer companies, which tend to, like a WorldRemit, or we have Caudoux and companies like that are very broad and global in their scope. And those seem to have easier time because they have faced less of that regulatory barrier and structure.
Yeah, I don't think, I hate the term fintech, but financial services startups, I don't think they're any more or less favored. There's elements of if it's a balance sheet business or not, but you have PayPal is the original sort of newcomer. It's been listed for a while as eBay and now spun off. Square has been doing well. There's been some that haven't done quite as well, Lending Club and On Deck, but they still went public and they're trading companies.
Yeah.
I would say let's have that discussion in 3 or 4 years' time because the real, what people call fintech, the sort of big wave, the Cambrian explosion, is only about 7, 8 years old. I mean, we started Anthemis 10 years ago, and I can tell you there was, I had a spreadsheet where I tried to get every fintech startup early stage on it, and I'm sure I didn't have that, but it wasn't very long, the list. So, and the cycle of building financial services company, this is sweeping generalization vis-a-vis the lots of other categories of technology startups, is usually a little bit longer. I mean, we found this.
Right.
So if the median is 7 years for a consumer internet company, it's probably 10 years for a fintech company because you have to do regulation and stuff.
Right.
So I think the IPO wave is probably 2 or 3 years away anyways. And then the other problem is the competition, but I think this is good for everyone in the long term, but the competition from super late stage private capital, SoftBank buying the world before it ever gets listed.
And there's one more point, and that is that I think that when I go around and talk to folks in Japan and in Israel and other places, a lot of the banks, the large ones, are a little bit nervous these days, and they don't want to miss things, and they feel that they don't want to see what happened to, say, Blockbuster versus what was that one? Netflix. Blockbuster getting wiped out by Netflix. They don't want that, so they have certain advantages, and again, this regulatory and the capital that they have, but they're afraid. So some of them are starting to buy things, and we just saw yesterday Payvision bought by Ing Bank. So some of these things are being bought before they go public.
Do you see a potential uptick in strategic exits then, in deals, financial services companies buying fintechs over the next year or so?
I don't know necessarily that's going to be a substantial uptick, but I think there's a lot of activity that's happening now. But again, a lot of these businesses are growing. They're becoming larger. They can become more impactful to a bank's operations or even their bottom line. And so I think from that standpoint, sure, you might see some more activity in a couple of years relative to today.
Arnaud, looking into your portfolio, tell us what you see. I mean, you talk to these startups all the time.
I totally agree on a few things. First, I think biotech is a good comparison. And the big difference between fintech, I hate the name too, because I mean, it's encompassing too many things. But biotech, they have had with pharmaceutical companies the subject that fintechs have had with banks only 10 years before. So now you have pharmaceutical companies which have learned to work in an open way with biotech companies, which allow them to grow and to IPO. And if I look at my portfolio, the best hits in my portfolio actually are biotech companies which we invested in 10 years ago, which have IPO'd and which are worth billion euros. This is going to be in 5 years for fintechs, because now you can see, even from today and yesterday, banks are becoming much more open in the way and much more aware in the way they work with fintechs than they used to be even 2 years ago, where the competition was fierce, really fierce, and where they tended to buy anything that was frightening them. Not to build on it, but almost sometimes to destroy it. So this is over, and that's a very good news. If you listen to banks talking about PSD2 today, and you listen to the tapes from last year, it's crazy in 1 year. So I think late-stage growth is starting to happen. If you look at the last deals, even Ledger, which is a Bitcoin company basically, has raised 60 million euros last month. And by the way, these were US funds coming in France to invest in Ledger. So definitely, even if we had not late-stage growth funds in France, which we have, we can see the US funds and the UK funds coming in when there are good deals. So really, I'm not worried about the availability of capital. But these deals are starting to happen.
So the availability of capital is not a concern?
Definitely not.
Okay.
And so the main concern is where are the deals? Are we going to have good deals at 100 million euros? And we are going to see those deals we are starting to see.
So what are the concerns? Perhaps take this from the point of view of investor appetites, what your LPs want from, say, a late-stage fintech play. What if the availability of capital is not a concern, what is the concern?
To me, the concern is the market. What space do you have on the market? What kind of market opportunities do you get? Fintech has tended to be, except for the technical platforms, has tended to be a very national business. And you don't find a 100 million euro deal on a national business in Europe. No way. Maybe in the US, maybe in China, definitely not in France. So European harmonization is fundamental, and we start to see companies who operate in Spain, Germany, France, Austria, UK, etc. This is happening, but this takes, again, a lot of time because you have to jump a lot of regulatory borders. So that's one big thing. The other big thing for France has been the competition from banks, because commercial banks in France are very efficient. And it's very difficult, but it's a bit like Frank Sinatra. If you can make it there, then you can make it anywhere. And it's starting to happen too. If you look at United, we are an investor in United. They have been successful in breaking through the consumer lending business in France, and now they are deploying across Europe.
Is the climate changing under President Macron?
Yeah, for sure. I mean, it's also, basically it's an ecosystem. You need every stars to be aligned. So you need a talent pool. We have the talent pool. You need capital. We have capital. And you need the right mindset and the support for entrepreneurship across the society. This was maybe not so clear in France 5 years ago. I think it's absolutely clear today, and it's mainstream. And it's very new. If you just look at the labor laws, 2 years ago, I would have gone to Bloomberg and say we are going to reform the labor market in France. You would have laughed. And you would have told me, and you would have been right. And you would have told me people will be in the street and they will be against it. And nobody was in the street. So things are really changing. I mean, the mindset of the society is really changing, and we can see a lot of successful society, a lot of successful entrepreneurs, and everybody is perfectly happy with that.
I mean, let's pull back and just look at the macro, too. I mean, we see a period of economic growth in Europe that everyone was dreaming about during the sovereign debt crisis and so forth. Stefan, I mean, how is just the economic growth story in Europe, how is that going to affect what you can do on your exchange?
You have three big things that have changed over the past few months that are leading to an actual relocation of assets from other mature countries towards Europe, in particular continental Europe, because the UK is experiencing its own experiences.
That's one way to put it.
They try new things. Three things. First, all these issues about the risk of populists taking over Europe, the debate about whether the Dutch government was going to be taken over by populists, or 12 months ago in France, there were all sorts of debates, and all of us who do roadshows, we were getting questions about what is Mrs. Le Pen going to be elected, etc. There has been, I wouldn't say an elimination of the populist threat, because this issue still exists, but a confinement which is very strong. So that's fundamentally new. It's not anymore on the map. The Brits had the Brexit, the US had Mr. Trump. We had a different way to confine populist feelings in continental Europe. So that's the first thing. The second thing is that the numbers are just better. And the numbers are better. The growth numbers are not to 2% growth, which doesn't seem very exciting by global growth standards. But considering the risk-reward ratio that you have in this part of the world, which is better than in terms of the risk side than in the rest of the planet, it's very good. So delivering 2% growth in a population of 450 million people with, in average, very high standard of living, with a much more cohesive society and a strong purchasing power, and strong, it is good. It's good, and it has an impact which is stronger than in any other places in the world where you would have just moving from 1.7 to 2.2%. That's the second thing. And what is even more important than GDP growth, I mean, there have been good numbers released for France yesterday morning. The European Commission has improved its forecast for Europe 2 weeks ago. So did the IMF. What is even more important are the confidence indices, all the market indices and so on. This is the first time for the past 10 years that confidence indices are so high. And that means a lot. That means that people have started to invest again, and that's across the continent. Then when you add on top of that the final thing, which is that fiscal consolidation is behind us in every country except France, where we are late, but everywhere, reducing debt burden and deficit is done. It's a different outlook for the next 2 or 3 years.
So it's reasonable to assume then that the LPs in your firms, the LPs in your funds, would be a little hungrier for perhaps later stage growth capital deals in fintech in Europe. Does that follow? I mean, just given the macro?
Well, we've never raised a late-stage fund as of yet, but I think the animal spirits are clearly returning, and you know, the contrarian me, I used to be a trader, is like, well, is it time to sell? But I don't think it is. But I was thinking too, one of the things that we would like to see is a macro level, is more M&A, but I'm not talking about the M&A of like the incumbents buying new things, and that's great, that's fine. Right. But within some of these emerging winners that are 5, 7, 10 years old.
We have seen some of those deals in the last year.
But they're very few and far between. And those are, you know, I have a few combinations in my head, which I'm not going to say, even though they're not listed companies. I think it would be inappropriate. But those combined beasts would be, you know, very interesting public companies, right? Where you have a little bit more diversity, because the natural startup, and I think it's particularly true in finance, it's complicated, it's regulated, is, you know, the good winners have been laser focused, but then to build a more robust business, it's a little bit embarrassing to say, but there is some method in the madness of business models like JP Morgan and Allianz and what have you. those are notoriously hard to put together. I don't think that's unique to fintech. It's startup. You have big egos, good and bad reasons in founders. I think the bigger problem, David, I don't know if you'd agree with me, is oftentimes late-stage venture companies. You got a lot of VCs around the board table, combine it by 2 or 3 companies, and everybody has their own views, their own fund dynamics.
Sure.
But from a structural point of view, the giants of fintechs that might be listed companies on Euronext or on NYSE or what have you, in my head, it's not anyone I can point to, it's those 3 together. That's a really interesting company. Big revenues, big profits, big growth.
So a few rejoinders. Number one, I think LPs tend to look in the rearview mirror.
Yeah.
And so unfortunately, the returns in Europe have not been marvelous in this late venture class. And so they tend to think US is the place for venture and Europe is for buyouts and other things like that. Now, I think the reforms that you're mentioning are valid, they're good, I salute them. Encore, plus fort, would be marvelous in my reaction. I do think, though, that US is going to regain some shine now. This corporate tax reduction is magnificent, and the regulatory reduction even more magnificent. And, for example, the CPFB restrictions that the new administration is putting on, I think are going to be a big spur to fintech. So I think that's going to take a lot of stuff. And then Asia just keeps continuing their march, giant growth. So I would like it if the world goes and grows in all these regions. And then, of course, Latin America and Africa have been growing at quite speedy things. We're going to have a very modest energy outlook for a while. There's so much new production coming on board. I don't think that's going to be a thing. But the problem that Europe will have eventually is that your interest rates are going to have to come up. And that's going to probably change something. And I would disagree a bit. I don't think 2% is enough for Europe. I want more social mobility here. I want the people who are at the lower levels, in les banlieues, to be able to move up and to sit in these chairs. And I think you need more than 2, even 2.5 for that.
Let's be clear, I was not making a rosy comment in absolute terms. I was saying that when you compare what the picture 1 year ago with what it is today,
Absolutely.
The momentum has changed fundamentally. This part of the world, including France in particular, which was supposed to be a sort of big museum, has demonstrated in a 6 months' time that you could do structural reforms and change completely the role. I would recommend, I know that the euro is high and it's more expensive to buy assets in Europe than it used to be 18 months ago, but by now, before it is too late, it's the right time to invest on the continent, because there are a few things that are not going to change and that are fundamentally different with the US. This part of the planet, this group of 450 million, is the place in the world where people invest through their tax the most in the formation of human capital, in education and talents.
Yeah.
This very country here spends 70 billion of taxpayers' money per year to train people, which is twice what we spend for national defense. It is by far the spending of this country is 70 billion for education, 42 million for servicing the debt, 34 million for defense. So imagine, so it's true that households don't spend money as much as they do in the US, and that you have to compare apples with apples, but also universities don't charge a margin on
So
education.
do we get to talk about education and how fucked up that is all
No,
over the
but
world?
my point.
Sure.
Because
Yeah,
if we do,
absolutely.
I'm up for that.
Absolutely.
It's a very relevant point. When
It is a
you
relevant
consistently spend 70 billion per year of taxpayers' money to train people, the average standard of it. Now then, education of talents that you generate for industry, innovative industry. But now you get to other problems. The number one guy of a top engineering school, which is École Polytechnique, was offered a €1 million package by Google to join their top astronaut program that they have there in the West Coast. So we have other problems. All taxpayers pay for educating good people who are going to work in barefoot 25 hours per week in the West Coast.
But that person will probably come back to France, because all my French friends come back to France, and so that's okay. The problem France has is spending billions of dollars educating people for the jobs of 1970. and the culture of 1970. It's not just France, so I'm not picking on France,
But if you look at facts, I mean, we finance a lot of companies which flip to the US, and they keep their engineer base in France for a very simple reason. You can ask any one of the 200, 300,000 French people in the valley. They will all tell you the same thing. You pay twice as less for someone who is twice as competent and with 3 times more faithful to your company. So this is the key. The talent pool is here. It's cheaper, it's better, and it's more faithful.
Are we talking about education? But so France has the best engineers. You know, there's other places.
Part of the countries who have the best engineers.
Fantastic engineers. They built the city of London, all the derivatives businesses. Now they're building Silicon Valley. But the issue, those people, whether they're in France or Canada or US, you know, they're always going to be okay in any economic paradigm. They'll be better, or you know, like, you know, if the way that France educates them, it's sort of putting fuel on the fire. That's great, but the kinds of jobs for the non-elite, and I would put those people, you know, if you go to, forget even Polytechnique, just if you go to, you know, an engineering school, you do a bac C, or, you know, you're already on the road to that safety in our new world. But the other 95% of people, which used to be super well served by a public education in countries like France or even the UK, and like when I grew up in Canada, where everyone, the École républicaine, that's still great, but it's the way that, like, I see my children, they're being educated to work in a world that existed, 9-to-5 job, follow the rules, you know, progress, that was the world 50 years ago. And, you know, as I said, I have teenage children, and they really, they notice it. They're like, this is irrelevant. And not in the way that usually teenagers say it's irrelevant, they have forever, but it's like, the world is not like this. What am I going to do? I'm not going to be able to have jobs like you, Mom or Dad. I don't know what they are.
So you're saying that this is really going to hold back the development of a new economy, a startup economy?
It could.
Yeah.
It could. And so I think, and then...
Because there's an effort by the Macron government to very much kind of bring French citizens back to France, to entrepreneurs, and to bring non-French to Paris, to make Paris a startup hub, to make France a startup hub.
Well, like Station F and what l'école qu'il a fait, 42. Those kind of initiatives, those are
more tangible stuff. I mean, the impatriate regime makes France, for people who come back after 5 years abroad, or who come back for the first time to work for a specific company, a tax paradise. I mean, you end up paying all in a marginal tax rate of 22-23%. So you are better off than the global taxation of a U.S. citizen. So it's. I mean, there are plenty of things that have been enacted over the past 2 years, because this specific scheme was existing before Macron took over, and it was extended to 8 years duration before by the previous government. But there is a comprehensive package which is implemented to create a new level of attractiveness. But it's going to take time. The only reason why I distracted the conversation towards education in the fintech form is that I believe that long run it is the most sustainable feature of this part of the world. The cohesion, and the sort of continuous pumping in talent pool. Maybe backwards.
But will investors buy that story?
Well, I definitely think so.
I think they will.
Yeah, I definitely think so. I think as long, I mean, Silicon Valley taught us, and the rest of the world has followed, that the free movement of capital and labor, and really high quality labor, drives innovation, right? And investors are seeing that you've got really talented engineers living and working here. They're smart. I don't necessarily see, at least in my portfolio companies, the 9-to-5, 1970s type folks.
No, there's no, those folks aren't in the companies that we sort of back. But I think we have to acknowledge that not everyone becomes a startup founder, not everyone becomes a Polytech engineer.
Yeah, Sean, you're
or a
talking more
banker.
Societally,
Yeah, absolutely.
But those, I would say that those things take time, and I guess
They absolutely take
to Stefan's point, the vector is heading in the right direction.
Yes,
right.
yeah, for sure.
Even if it's just 2% growth, that's a lot better than where we were a couple of years ago. And I think that level of confidence, particularly
2% growth plus, I think the point you made, the whole package of societal cohesion and relatively lower inequality and quality of life. So in the short term, as you say, it's great if you're returning to France from a financial point of view. But again, all of my French friends when I was living in London, really that might be the year they come back, but they're coming back because France is a great place to live in, especially when you have a family and the risk with, the risk maybe in the U.S. is, dystopianism, right? And
You have to explain what you mean.
So I'm a rootless person. I was born in Canada. I'm a citizen of nowhere, as Miss May
You're a
would
citizen
say.
of nowhere, right?
And I find wonder everywhere I go, but I also find, sort of the cracks. And, you go to San Francisco and you can't be but blown away by it reminded me of the city of London or Wall Street back the smart people from everywhere in the world getting on and just like excited and passionate about what they're doing. But then you're tripping over, you can't walk down Market Street without, sort of plugging your nose. And there's sort of, that as a metaphor, I don't know.
He's talking about
the inequality.
Specifically homeless problem. Actually, it's really a mental illness and drug addiction problem. And it's a very small group of people, about 7,500, but they're chronic. And our bad city government, I'm going to blame San Francisco, I'm looking right at you, mayor and supervisors, they refuse to solve the problem.
Right.
Giuliani and Bloomberg fixed it in New York. It doesn't exist there anymore, really to the same degree. And we have a really problematic viewpoint that these people should just be left to their own devices and in their own filth, and it's a shame. We need to help them and take care of them, and our city doesn't do that.
But I guess for the context of our discussion, I mean, all of these kind of societal ills that you're describing right now, they do form part of the story. I mean, ultimately, they do form the investment thesis.
What I can tell you is that from the few top 5 large global institutional investors we talk to, when they come to us to have country reviews, geographic reviews, and so on, I was astonished to find out that among their criteria of investment, one is political stability and a part of it being social cohesion. Everyone has been completely hurt by what happened in the UK. 2 years ago, that was
You're talking about Brexit.
The place to be, etc. Now, we all knew that in every developed countries, globalizations for 20 to 30% of our population is the largest transfer of wealth, revenues, income from middle class from all countries to middle class to in emerging countries. So we all have to face those problems. Each country addresses, mitigates, absorbs, finds solutions to address this issue in a different way. In the UK, for all sorts of reasons, they decided to ignore the problem, and they created a sort of separate society. And the way the problem blew up was through the Brexit vote, among other reasons why it happened. In the US, the Trump election was driven in part by this revolt from this middle class that saw that they were net losers of globalizations. So in continental Europe, for all sorts of reasons we are not here to discuss, the outcome has been different. The problem has been confined, and because there are much more mitigants to absorb these frustrations. Now, this is an element of investors' choices, because they have learned the hard way what investing in the UK meant in terms of the currency, prospects for those investment, and the need for diversification. And that has become a component much more important than I thought. Now, all this intellectual debate about inequalities, blah, 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 translates eventually into concrete midterm or long-term preferences of those languages. Now, they are not startup guys and so on. I'm just sustaining that to come back to fintech. When you invest in an IPO company, you look at scale, growth, and you look at barriers to entries. One of the specificities of fintech is that they deal with money, and money, to a large extent, in most countries, is more regulated than food or toys. And therefore, barriers to entries crystallize more precisely on the fact that you win specific regulatory milestones. So either you have passed them or you don't. If you have passed them, you are supposed to be ahead of the others who have not. And therefore, the focus on the regulatory environment is also an element. Is the regulatory environment volatile or not? Is a critical element for the IPO as well. And the other one is scale. One of the weaknesses of Europe is that, to a large extent, the markets are still fragmented on the financial, but they are becoming, the trend is less and less fragmentation.
Okay.
So whoever bets on European platform to address the needs of 450 million people midterm, and who believes positively in Europe, is going to make more money than the ones who will be in a wait-and-see mode.
Okay.
Just
David?
a quick rejoinder, and leave on an optimistic note, because I think this is a fintech conference, and one of the things that we're seeing in Silicon Valley is something that we weren't smart enough to invest on the thesis, but we figured it out after we'd made the investments, and it's what I call leveling the playing field. And talking about social cohesion, I think part of the reason for the populist reactions in Europe and the US has been that people feel that things are rigged against them, that the wealthy and the institutional do well, and middle class and lower don't do as well. But technology has a way forward that's a triangulation that makes it easier for even now less fortunate folks, just through the power of the computing and communications in everyone's pocket, allows you to have an asset manager figuring out how you should pay back your loans in a most optimized way, so you never miss one. Things like this, where we take very sophisticated algorithms and deploy them very cheaply and easily, letting everyone use them, I think goes part of the way. It'll lower costs for average people, give them more feeling of empowerment, and probably raise their financial savings, which is a crisis for all the countries. All of us are not saving enough. So I'm optimistic that technology is a part of the way forward.
Good, good. Well, I think we got a little far afield on that, but that was an excellent, rollicking conversation, and I think a fitting way to kind of ease into the end of this conference. And because I think that when you come up with an investment thesis, these are all variables that have to be examined and input. You got to go big, you got to go macro, but you got to look at specificity as well. So I would just like to thank our panel, David, Sean, John, Arnaud, and Stefan.